Tesla just launched driverless rides in a brand new city. And on the surface, that sounds like exactly the kind of headline that should send the stock soaring. But here's what most investors completely missed this week. The exact same week Tesla expanded into Miami, the company was also dealing with a federal safety investigation, a fatal crash involving its self-driving software, and a stock that dropped hard despite blowing past delivery expectations. So is this expansion actually good news for your portfolio, or is it happening at the worst possible moment? Let's find out what this really means for Tesla investors. If breakdowns like this help you separate the headlines from what actually matters for your portfolio, subscribe so you don't miss the next one. Like this video if honest, risk-aware stock analysis is useful to you, and comment below which stock you want us to cover next. Let's start with what actually happened, because the news itself is genuinely significant. On July 3rd, Tesla launched its Robotaxi service in Miami, marking the first time the driverless ride-hailing program has expanded outside of Texas and California. The service covers a zone of roughly 10 to 14 square miles in western Miami-Dade County, notably excluding downtown and the busy Brickell area. For a company whose entire long-term valuation increasingly depends on proving autonomous driving works at scale, every new city is a meaningful data point, and Wall Street watches these expansions closely as evidence the technology is maturing. But here's why this particular expansion comes with a genuine, specific risk that's different from anything Tesla has faced in its previous markets. Tesla's entire self-driving system relies exclusively on cameras, with no radar and no LiDAR sensors backing it up. Competitors like Waymo, by contrast, combine 13 cameras with 4 LiDAR units and 6 radar units, giving their vehicles multiple independent ways to detect obstacles, even when one sensor type struggles. Florida's weather is about to test Tesla's camera-only approach in ways Texas and California never fully did. Sudden tropical downpours and intense sun glare, both routine, daily occurrences in South Florida, are exactly the conditions that challenge camera-based systems the most. Since heavy rain can obscure lenses and low-angle glare can wash out a camera's ability to distinguish objects clearly. This isn't a hypothetical concern. It's the specific engineering challenge Tesla chose to accept by expanding into this exact climate with this exact technology. Now let's zoom out, because to understand why this matters so much for your investment, you need to understand just how much of Tesla's current stock price already depends on autonomy succeeding. Tesla currently trades around $390 a share, down roughly 11% so far this year, and sitting about 20% below its 52-week high of $489.88 set back in December. Here's the number that changes everything about how you should think about this stock. Tesla trades at a forward price-to-earnings ratio in the range of 200 times expected earnings, compared to traditional automakers that typically trade between 8 and 12 times earnings, and even richly valued big technology companies that usually trade between 25 and 35 times earnings. This gap is not an accident or a mistake by the market. It's a direct reflection of the fact that investors are not valuing Tesla as a car company anymore. They're valuing it as a bet on autonomous driving, robotics, and artificial intelligence, with the actual vehicle business acting almost as a financing mechanism for that much bigger bet. This is exactly why the recent earnings and delivery numbers tell such a strange story if you only look at the headlines. In its first quarter of 2026, Tesla reported revenue of $22.39 billion, up nearly 16% year over year, with earnings per share of 41 cents, beating the consensus estimate of 39 cents. Then, in early July, Tesla reported second quarter deliveries of 480,126 vehicles, absolutely crushing Wall Street's expectation of around 406,000, representing 25% growth year over year, and 34% growth from the previous quarter alone. By any normal standard, that's a spectacular result. So why did the stock actually fall nearly 8% on the day this great news was announced? This is what most headlines got completely wrong, and it's the most important lesson in this entire video. When a stock's valuation already assumes something is going to happen, simply confirming that the more predictable, traditional part of the business is doing fine doesn't move the needle, because that was never the real question investors were asking. The delivery beat told investors Tesla can still sell cars well. It told them absolutely nothing new about whether the far more valuable robotaxi and autonomy story is actually working. And in the same stretch of time, that autonomy story ran into serious turbulence. Let's talk about that turbulence directly, because this is where the real risk lives. On June 19th, a Tesla Model 3 in Texas veered off the road and struck a home at high speed, killing a 76-year-old woman inside the house, with the driver reportedly telling investigators an automated driving assistance system was engaged at the time. The National Highway Traffic Safety Administration has since opened a federal probe into that crash, though Tesla has publicly pushed back, stating vehicle data shows the driver had manually overridden the system and was traveling 73 miles per hour with the accelerator fully pressed at the time of impact. Just 11 days later, on June 30th, a Tesla vehicle crashed into an outdoor dining area at a cafe in Simi Valley, California, killing one pedestrian and injuring 5 others, triggering another round of investigation into whether autopilot or driver assistance features were involved. And separately, Tesla's massive, all-electric semi-truck was involved in its first ever fatal accident, colliding with another vehicle near the company's Nevada Gigafactory, with early reports from local authorities suggesting driver fatigue rather than the automated systems may have been the cause. Here's why 3 separate incidents in such a short window matter so much more than any single one of them would in isolation. Tesla's stock price already assumes a future where its self-driving technology is validated as safe enough to remove human drivers entirely from millions of vehicles. Every headline connecting a fatal crash to Tesla's driver assistance or autonomous systems, whether or not the software is ultimately found at fault, chips away at the public and regulatory trust that entire multi-trillion-dollar bet depends on. This is exactly why Tesla stock fell 14% in a single session after the Simi Valley crash, even before all the facts were established. The market isn't just pricing in what happened, it's pricing in the risk that regulators respond by slowing down the very robotaxi expansion Tesla needs to justify its valuation. Let's talk about the fleet numbers, because this is where the gap between Tesla's story and Tesla's reality becomes most visible. According to Texas Department of Motor Vehicles filings published in late May, Tesla has only 42 autonomous vehicles officially registered for driverless ride-hailing in the entire state of Texas. For comparison, Waymo, its chief competitor, has 577 vehicles registered in that same state, more than 13 times Tesla's total. Independent tracking services have reported that the actual number of Tesla vehicles operating without a safety monitor in the car has been shrinking in recent months, rather than growing. A sharp contrast to Elon Musk's original prediction that the fleet could reach 1,000 vehicles within months of launch. There's also a structural limitation working against rapid fleet growth. Tesla vehicles built with an older computer system, known as Hardware 3, reportedly cannot run fully unsupervised self-driving without expensive hardware retrofits, and a large number of Tesla's vehicles sold between 2019 and 2023 carry that older hardware. That means Tesla can't simply flip a switch and turn its existing installed base of cars into a robotaxi fleet, which caps how quickly this business can actually scale, regardless of how many new cities appear on a map. Now, let's be fair and walk through the bull case, because the opportunity underlying this story is genuinely enormous, and dismissing it entirely would be just as misleading as ignoring the risk. Tesla has accumulated over 9.38 billion miles of real-world full self-driving data, along with 1.28 million active FSD subscriptions, representing a 51% increase year over year. That data set is a genuine competitive advantage that's extremely difficult for any competitor to replicate quickly, since training better autonomous driving software depends heavily on the volume and diversity of real-world driving data available. If Tesla can successfully turn this data advantage into a working, trusted robotaxi network, the total addressable market for autonomous mobility has been estimated by some analysts at up to $10 trillion globally. And even capturing a modest slice of that market could transform Tesla's earnings power for decades. Beyond autonomy specifically, Tesla's energy storage business, covering products like Powerwall and Megapack, deployed 13.5 gigawatt hours in the most recent quarter alone, up from 9.6 gigawatt hours a year earlier, giving the company a growing, profitable business line that provides at least some valuation support, independent of how the robotaxi story unfolds. So what does Wall Street actually think about all of this uncertainty? The picture here is about as divided as you'll find on any major stock in the market. Aggregated ratings from over 40 analysts show a consensus average price target in the range of $400 to $404, with the majority rating landing on hold rather than a clear buy or sell. But here's what that average completely hides. Individual price targets range from as low as $25 a share on the most bearish end to as high as $600 on the most bullish end, an almost 25-fold difference between the most pessimistic and most optimistic professional forecasts. When analysts, who all have access to the same public information, disagree this dramatically, that's not a sign of a straightforward investment decision. It's a sign that Tesla's stock price genuinely depends on which version of the future actually plays out: autonomous mobility giant or a struggling premium automaker with an inflated valuation. Let's talk valuation directly, because this is where the investor decision really comes down to a specific bet rather than a simple analysis of the numbers. Some analysts have attempted to separate Tesla's valuation into pieces, estimating that if you stripped out any value assigned to Robotaxi and Optimus Robotics entirely, Tesla's core automotive business would be worth somewhere in the range of $150 to $200 per share, based on how traditional car manufacturers are valued. That means, at a share price around $390, the market is effectively paying an additional $150 to $200 per share purely for the possibility that autonomy and robotics succeed. Technology that, as we've just discussed, is still working through real safety questions, regulatory scrutiny, and a fleet that remains small, and in some reports, shrinking rather than growing. So where does that leave us for a final verdict? Tesla's core vehicle business is showing real signs of stabilizing, with genuinely strong delivery growth this past quarter after a difficult stretch. But the specific catalyst that could justify Tesla's premium valuation, a large-scale, trusted, profitable robotaxi network, is running directly into a wave of fatal accidents, federal investigations, and a fleet expansion that remains far smaller and slower than the narrative suggests. Given all of that, Tesla currently sits closest to a hold for investors who already own shares and want exposure to the long-term autonomy story without adding risk at current prices, and a speculative watch, not a buy, for new investors until there's clearer regulatory and safety resolution around the recent crashes and real evidence the robotaxi fleet is actually scaling rather than shrinking. Looking further out toward 2027 and 2028, this stock genuinely comes down to a binary-style bet more than almost any other major company in the market. If Tesla resolves its current safety and regulatory questions, successfully retrofits or replaces its aging vehicle fleet, and scales robotaxi revenue meaningfully by 2027 as management has projected, some analysts believe the stock could reasonably reach the $600 to $750 range by 2028. If instead, the regulatory environment tightens following these recent fatal crashes, or the technology continues struggling to scale beyond a small, shrinking fleet, several analysts have warned the stock could fall back toward a range more consistent with a traditional automaker valuation, potentially 70 to 80% below where it trades today. Very few major stocks in the market carry that wide a gap between their best case and worst case outcomes. So let's bring this all together. Tesla's Miami expansion is a real, meaningful step in its autonomous driving ambitions, but it's arriving during one of the most safety-scrutinized stretches in the company's recent history, testing camera-only technology against exactly the weather conditions that challenge it most. The delivery numbers prove Tesla can still build and sell cars at scale. They don't prove the far more valuable robotaxi bet is working yet. And recent events have only made that question more urgent, not less. Remember, great investing isn't about chasing hype. It's about making informed decisions. This video is for educational purposes only and is not financial advice. Investing involves risk, including the potential loss of principal, and you should always do your own research or speak with a licensed financial advisor before making any investment decisions. If this breakdown helped you see past the headlines on Tesla's Robotaxi story, hit subscribe so you don't miss the next one. Like this video if honest, risk-focused stock analysis is useful to you, and comment below which stock you want us to break down next. Don't forget to turn on notifications so you never miss an upload. Thanks for watching, and we'll see you in the next one.